Welcome back to another lesson, traders. Great work so far. We've reached lesson 9, and in this lesson we're going to go over the all-important trade plan. So let's dive right in. The trade plan. This is something you've heard about in the previous lessons, and it has come up quite often. So now that we've discussed all the elements of trading, we'll now see how it all comes together and ties in with the trade plan. So what is the trade plan? As we've said before and multiple times, trading is a business and should be treated like one. And the trade plan is every trader's business plan. This is where the trader evaluates every trade idea or setup. They must answer core questions. These are: how much am I willing to risk? Your risk tolerance. Is the risk worth the reward? Is the juice worth the squeeze? The risk-reward ratio. Remember we spoke about those? And then lastly, how likely am I to succeed? What are your high probability setups? So by drafting a sound trade plan, a trader is preparing for a set of both negative and positive outcomes, thereby incorporating sound risk management practices and high probability setups with the aim to maximize the positive result and minimize the negative one. Let's continue. So what goes into constructing the trade plan? It's the process every professional trader must go through before taking a trade. It encompasses 1. Identify the setup or opportunity. Remember we covered technical analysis where we spoke about trend, support and resistance, and price patterns. Next, we use technical analysis to identify the trigger price or the entry, and this is going to be a technically sound level. Then we identify the stop loss or the SL. At what point is the trade no longer valid and I take the loss? And then after that, we have to identify the quantity or the size of the position. If my stop loss is 2 points away and my risk tolerance is $100, then I can only take 50 shares as I must not lose more than my risk tolerance. And then lastly, profit-taking scenarios or partials. Based on my analysis, where is the next technical level I can start to lock in profits? Is there clear resistance or clear support? To understand this fully, let's look at an example and incorporate everything. So in our example and in the trade below, the trader elected to watch Coin or Coinbase as it was starting the day with a 2.5% gap up on good news. Remember we covered gap ups where the difference in the closing price of the previous day and the difference in the opening price of the current day is called the gap. So Coin was starting the day up 2.5% higher than the previous close. And the trader's plan was to look for a long setup to join the upside as the stock had been trending higher on the daily chart. You can see the daily chart below as well. So starting on the laptop on the left, you can see the daily chart of Coin, and you can see that beautiful uptrend, very strong momentum to the upside and currently moving higher with lots of higher highs and higher lows. And then on the right, you'll see the 1-minute chart of the current trading day. So after examining a larger time frame, the daily chart, the trader now moved to the smaller time frame, the 1 minute, and spotted a bull flag technical formation at the start of the day, with the top of the flag being at 170.85 cents and the low end, the risk area, being 169.35 cents. The trader decided they want to take the trade and they entered long with a buy stop order at 170.85 cents, risking approximately 1.5 points. Remember the types of orders we went through? Buy stop order was one the trader elected to use, as they were specific about their entry price and had time to enter the order. They also placed a stop loss order via the Modify Position tab at 169.35 cents after entering the trade, and then had a rally in their favor, taking partial profit at the 174 and 175, while the stock continued to rally higher throughout the rest of the day. If the trader had a risk tolerance of $500 per trade, They would buy 333 shares, or calculated as 500 as their risk tolerance divided by the stop distance, which is 1.5 points, and that would be their position size. Let's now say they took 300 shares off at 174 and the rest, or 33 shares, at 175. Their profit would have been approximately $1,082, and you can see that calculation, which is 300 shares times the distance from the entry to the first profit target, which is 3 points and 15 cents, plus 33 times the distance from the entry price to the second partial profit, which is $4.15, and that gives us that 1,082 total profit. And this would be just over 2 risk units, and that means that the trader would have achieved a risk-reward ratio of 1 to 2. Again, as we mentioned before, this is a good return for a day trade. So now that we've gotten the essence of the trade, let's now highlight the elements of the trade plan clearly. Again, we've covered all of these elements in the previous lessons, and now we're tying it all in with this trade plan. So first, we identified the setup and opportunity. There was a trend to the upside on Coin's daily chart. Coin's daily was trending higher, the stock gaps up on good news and is starting the session strong. So we anticipate that we will get some continuation. And then there's a price pattern, meaning there's technical analysis. We're able to identify a technical pattern that has a high probability of moving in our favor. And in this one, the stock is strong, there's a bullish tone in the market, and we're looking at a bull flag forming on the 1 minute. So then we identify our trigger price, or our entry price. This is a technically sound level, which is short-term resistance, and was identified at 170.85 cents. Now we must identify our risk level to see at what point the trade is no longer valid, and if price were to break the resistance and then come back down and break the support of the bull flag at 169.45, the trade idea and the pattern would no longer be valid. Therefore, the trader would have to take the loss, and that would be 1 risk unit. Now, since we identified where the trade is no longer valid, we must calculate the size of our position, or the quantity, to ensure that we're not going over our identified risk tolerance. The stop loss is 1.5 points away, and my risk tolerance, or the trader's risk tolerance, is $500. That means that I can only take 333 shares, as I must not lose more than my risk tolerance. We went over the calculation, which would be 500, which is your risk tolerance, divided by the distance to the stop loss. Now let's talk about where we can take profit, our profit taking scenarios. Can we get a good reward on the trade? So as we identified before, it's a daily breakout. The trend is to the upside, the momentum is to the upside, and if we get continuation, we expect there to be a lot more buyers coming into play. So the trader got into the trade, took partials into the whole numbers as they were natural resistance levels. Remember, we went over whole numbers or round numbers. This is where investors normally think about selling or buying shares. Psychologically, whole numbers are what occur in their mind, and that's why they act as natural resistance and support levels. If you look at the chart on the right, you can see that as price touched 174, it started to fade down again, as there was selling pressure there with investors taking off, but it bounced and continued higher, and you can see at that 175 the same thing happened. Price briefly got above it and then started to sell down as there was selling pressure there. But that selling pressure will always wane, especially in an uptrend, as buyers are looking to buy into dips as well. If you examine the chart further, you can see that there was a push higher to 176, where again there was a pullback below that as there was selling pressure at that level as well. This is why these round numbers and whole numbers make for very good partial taking points just before or just after, as they are natural technical levels. And also, this proved to be a reasonable risk reward target. As we said before, the trader started locking in profits and achieved a risk reward ratio of over 1 to 2. So now that we've covered that trade plan in detail, one of the important things that we must do as traders is following the trade plan, because there's no point in planning out the process and putting all your time and effort into it and then just scrapping the plan. So every professional trader knows that we must trust the process. We must respect the work that we put into the trade plan. Your trade plan should be the result of a high level of preparation. We take our time, we examine, we apply our knowledge, and then we execute. Failure to follow your trade plan will adversely affect your profitability and ultimately longevity as a trader. It will definitely affect how well your trades are going. So some examples of not following your trade plan means not respecting your stop, you're stopping out too early, or you're letting the trade run against you too long, so you're taking a larger loss than initially planned. Next, taking profit too early. You're not respecting the plan, you're taking profit with a less than acceptable risk to reward ratio, and then the stock runs in your favor, hits your targets because of your preparation, you know that it's likely to head there, and you're left with nothing to show for it. Next, taking too large a position size or risk. A lot of traders end up taking too large position sizes because maybe they made the first two errors, which were taking profit too early and not respecting the stop loss, so they feel like they need to now get back up to where they should be, and they take larger position sizes and end up over risking and taking larger losses again. Again, we need to trust our plan, we need to follow our plan, which includes our risk tolerance as well as our trades and profit taking targets. And lastly, entering too early or entering too late. Chasing the price or not waiting for the setup to form. Being too anxious to get into the trade, or being too hesitant to get into the trade and then getting in very late because we're overthinking and again not trusting our process. This is one of the key things to your success and longevity as a trader. You need to follow your plan, and you need to also put in that level of preparation that is required into each and every trade and follow that plan. So that's it, traders. I hope you learned a lot in this lesson, and I hope it was an exciting one for you. Wishing you all the best. Take care. Bye for now, and see you in the next lesson.